Let's talk about the Japanese stock market. Right now, it's a real puzzle, isn't it? We're seeing these huge swings up, followed by some really sharp drops down. It's enough to give any investor whiplash. So today, we're going to cut through some of that noise and try to build a clear picture of what's really going on.
And that's the classic question, right? You see the market take a dive, and right away you're hit with this huge decision. Is this the dip I should be buying, or is this a warning sign to get out before things get worse? It's the kind of question that can just freeze you up.
And you're definitely not alone in feeling that way. You know, you hear about something like NVIDIA having these amazing earnings, and then you watch as the market sells off anyway. It's that classic buy the rumor, sell the news thing. And all these mixed signals leave you with that one big question. What does any of this actually mean for what I should do next? So, how do we find an answer? We're not going to guess, and we're not just going to react to the latest headline. Instead, we're going to use a really powerful mental model to bring some order to the chaos. This is going to help us see the whole story, not just the little pieces.
This is our tool, the four-layer analysis. The idea here is actually pretty simple, but it's incredibly effective. Instead of trying to look at everything all at once, we're going to examine the market through four very specific lenses. This helps us see how all these different forces are bumping up against each other to create the situation we're in right now.
All right, so here they are, our four layers. We're going to start with the raw market data itself. Then, we'll look at what governments and central banks are up to. After that, we'll check the health of actual businesses and trade, and finally, we'll zoom out to consider the big picture impact of global politics. Let's start peeling them back, one by one.
We're basically going to be detectives here. Think of each data point as a clue. Each one tells us a little piece of the story, and our job is to put them all together. First up, let's look at the market layer.
Okay, so here's our first major clue. A 2.4% drop in the Nikkei average in a single day. That's not just a little dip, that's a pretty serious move. It tells us that sentiment took a hard negative turn, at least in the short term. The big question is, why?
And this right here, this shows us a huge part of the why. While the market was dropping, the Nikkei Volatility Index, which a lot of people call the fear gauge, shot up by almost 25%. This signals a massive spike in anxiety. Traders aren't just selling, they're actively shifting into a risk-off mode, which means they're dumping riskier things like stocks and running for cover.
Okay, next layer, policy. For a long time, the name of the game has been monetary easing. Keeping interest rates low to get people spending. But now, with the yen getting weaker, the conversation is shifting. There's real talk about raising rates, and that's a massive change that spooks the market, creating uncertainty and the possibility of higher borrowing costs for companies.
Now this is where it gets really interesting. When we look at the trade layer, we see this kind of split personality in the economy. On the one hand, the services sector is still growing, which is good. But look at the other side. Manufacturing, which is a huge part of the Nikkei index, has actually been shrinking for 5 months in a row. That weakness is a major drag on the whole economic picture. And finally, we've got to look at geopolitics. Pressures from outside Japan are playing a big role here too. Tensions with China are directly hitting tourism and related stocks. And on top of that, a really weak yen creates the risk that big international money might start pulling out of the region, which just adds another layer of instability to the mix. Phew. Okay, so we've looked at all four layers, and we've found negative signals in pretty much every single one. Now, it's time to put all those clues together and get one single composite score for the overall market mood.
And the results, well, they're pretty clear. Every single layer we just analyzed is pointing in a negative direction. We've got fear in the market, a policy shift that's causing concern, a drag from manufacturing, and pressure from geopolitics. They all combine to paint a really consistent picture. And when we put it all together, we get our final score.
And that score is minus 0.4. Now here's the crucial takeaway. This doesn't mean the market is in a total freefall, but it does mean the overall mood is decidedly cautious and tilted to the negative. It's not a time to panic, but it is absolutely a time for vigilance.
Which of course brings us right back to our very first question. Now that we have this clarity, now that we know the mood is slightly negative, what do we actually do about it? How do we navigate this?
So what does all this analysis suggest? Well, first, it might be a time to lean towards more defensive, stable companies. And with the yen so weak, you've got to ask yourself which businesses are going to get hurt by the high cost of imported materials. They could be facing some real headwinds. On the flip side, who benefits from that weak yen? exporters could be really interesting to look at right now. And maybe most importantly, you got to watch every policy statement from the Bank of Japan like a hawk.
Ultimately, it all comes down to this really powerful concept. The best strategy right now is a combination of an alert stance and opportunity hunting. What does that mean? It means you stay on guard. You protect yourself from the clear risks we've just talked about, but, and this is key, you don't just shut down. You stay engaged, you watch carefully, and you stay ready to grab the opportunities that will always pop up in times of uncertainty. So be cautious, but always be looking.